What is going on? For today's lesson, I'm going to be going over the continuation slash discretionary model. This is the model that I use when I'm not trading my MEC model. Okay, so MEC model is simply going to be using all of these confluences, but I'm targeting an unfilled, unmitigated fair value gap that's going to be on the 15-minute or 5-minute time frame. For the continuation and discretionary model, I'm able to target other targets, other draws on liquidity like equal highs, equal lows, low resistance liquidity, data highs, and data lows. Now, these rules should be applying to the MEC model to give you that higher win rate, and I'm going to be going over all of these rules and overall bias and all that stuff. But let's get into it, okay? And I'm first going to show you guys all these rules and everything, and then I'm going to show you guys just a little bit of a drawing, and then after that I'll get into some real chart examples so you guys can actually have a good understanding of what it looks like on the charts, okay? So, starting off strong. All right, we have our bias, okay? So, are we trading inside and rejecting a higher time frame PDRA? Okay, so what I want to see for my bias is, are we delivering from sell side or buy side? Now, I'll get more in depth with this with the bias videos and with my daily profiles, but you want this to be aligned with your bias, right? So, are we rejecting a higher time frame key level? Are we respecting or disrespecting PDRAs? That sort of thing, okay? And are we trading inside, rejecting higher time PDRA? So, 15-minute, hourly, 4-hour fair value gap, order block, or breaker block, okay? So that's what you want to be looking for. Now, do we sweep prominent higher time frame liquidity? So what that's going to look like is going to be previous session, previous day. So previous session liquidity is going to be, that London highs, London lows. Those are going to be your key levels. Asia highs, Asia lows. Previous day also is going to be your key level, previous day high, previous day low, and then intermediate high, intermediate low inside of a fair value gap, right? So you can have a sweep of liquidity, and you can also, now mainly for the continuation model, you're not really going to get a very strong sweep of liquidity for your continuation model. You're most likely just going to have tap into some sort of key level. And then with that, what you're most likely going to see with really the continuation model is we will be delivering from some sort of higher time frame key level, right? So you could either there's a bunch of different entries that you can get from this. Now, there's times where we will have a sweep of higher time frame liquidity like this, and then we won't have a MEC model. Instead, we'll just have an inversion for value gap of the highest time frame. And this could be like the highest time frame right here, and this is your discretionary model. And from here, right, this is going to be a target, like buy side liquidity here. Let's say we have like relative equal highs here or something. That's going to be a great target. And this is not going to be targeting unmitigated gap, right? This is just going to be targeting some buy side liquidity. And we will be delivering from some sort of PD right here. Now, there will also be times where we will have this delivery happen. And then from here, we will then be rejecting a higher time frame key level like here. And let's say you don't get an entry with your inversion here, and instead we tap into some sort of 5-minute fair value gap, then this is still like valid. Now, although we are not trading inside and rejecting, trading inside of this higher time frame key level, right? We're bouncing off now a 5-minute. We still have that initial delivery being from that higher time frame key level. So that's all you really should be caring about, okay? So, okay, whatever. And lastly is time aligned with your bias, right? So you want to be trading during 9:30 to 11 and 1 p.m. to 2 p.m. 1 p.m. to 2:30 usually is like my cutoff time. Now, there are times where we have like FOMC, right? And FOMC does print that news candle at around 2 to 2:30 p.m. So you do want to be paying attention to that as well. Open low high close and open high low close. So if you guys don't know what that is yet, I suggest you watch the PDI video, but it's basically going to be when we have price trading like this. We'll have some sort of accumulation, then we will have manipulation lower, then we have a delivery higher. And I do go over, open low high close and open high low close and pretty much all the lessons, because it is a really, really important aspect of your trading, especially in this daily profile video I showed. And what you want to see if we were going to be bullish is a delivery lower first. So you'll have, your open here. Let's say it's 10 a.m. open, and to be bullish, you want to see price trade lower into some sort of key level, and then have your delivery higher. Okay, and then if we're going to be bearish, you want to see price trade like this, and then trade above opening price into a key level, and then once we are above 10 a.m. open, and then, or 1 p.m. open, 2 p.m. open, right? But the 4-hour candle is really going to be where you want to be paying attention to, like the 4-hour, that just means like 10 a.m. and 2 p.m., okay? Also 1 p.m. does have that delivery as well, since price is fractal, 1:30 as well, like the 30-minute candle, right? But I really want you guys to be paying attention to mainly AM session, especially if you're a beginner trader, okay? Because that's just gonna be when the best volatility is during the day. Now, for your entries, okay, is there equal lows, equal highs, low resistance liquidity, or data highs and data lows? Or I should just put, or clear buy side, sell side, okay? Now, is there equal highs and equal lows, right? So you want to be seeing if there's like a good target, right? So good targets look like previous, like prominent higher time frame liquidity, right? So this is your higher time frame liquidity, and we could be rejecting prominent higher time frame liquidity, but we also want to be targeting that higher time frame liquidity as well, okay? So if there's going to be also in your internal liquidity pools being equal highs and equal lows like this, then we could target that. If there's data highs and data lows, really, really good target as well. I should also put here like a new day opening gap. That's a great target. So, oops. New day opening gap, new week opening gap, or just overall clear buy side and sell side, and that's just going to be those types of liquidity pools that we see right here. Okay, so just any clear targets, right? You don't want to be taking trades targeting like a protected high and low. And what does that look like? Okay, so a protected high and low looks something like this, where we have maybe we've swept out, let's say, previous day high here, right? So let's say we had previous day high here and price ends up sweeping it out. Now you don't want to be targeting this as a target, right? Because this is going to be a high resistant high. It's going to be a really hard high to target, especially if we haven't generated any internal liquidity, and I'll show you guys what that looks like. But if you're just targeting this recent buy side here as this like only TP, this is not an obvious target, right? Because this isn't good liquidity pools. That's not a good liquidity pool, right? You want to be targeting low resistance liquidity, not high resistance, okay? Is there an SMT? So SMTs are going to be really, really crucial. And I mean, I do really love looking at SMTs, especially for the continuation model that I'll show you guys, because we can have an idea like this. And again, I'll show you guys down here. I have a better example. It's a lot clearer. But if we have an idea like this, right, and we have an SMT, let's say there's a 5-minute gap like right here. And if we have an SMT here, this is a really, really good sign that price is continuing to be bullish here. And this is going to be a valid SMT. And then we can, from here, take a long towards higher buy side. All right. Now, is there an SMT? Also, what you should be paying attention to is at your target, right? So you do not want to be taking trades, especially when we have like an SMT at the high. If it's a really good target, let's say it's like, previous day high, you're wanting to be targeting, and let's say ES is already taken out, and then we got this reaction from there, it's going to be very hard to target that because it's just going to be a high resistant high, right? ES already took it, and it's going to be hard to, also visualize this, especially as a beginner. I know I had a lot of problems with that because I would be thinking, oh my God, but it doesn't really look like NQ took it, right? So it should go still take it. But ES already taking that high shows that it's not necessary to take it again, right? So you want to be then paying attention to, is there higher targets above previous day highs or higher targets above this target? That would make sense for a price to disrespect this SMT and go higher or go lower. And we also went over that in the continuation, the conditions video, right? That if these conditions do meet up, and if we do keep respecting bullish PE raise, then this would still be valid long to take, okay? Finally, or two more here, is this the highest time frame inversion? You do want to be trading the highest time frame inversion in your trading leg, and what your trading leg is just swing highs and swing lows. So if you have a leg like this, you want to be taking the highest time frame inversion from here, from this side of this low, and you'll scroll down or scroll up through the different time frames to see what the highest time frame inversion is, if it's a 1 minute, 2 minute, 3 minute, 4 minute, or 5 minute. And from there, you can then target your buy side liquidity and whatever targets you have, okay? But you do want to be using the highest time frame inversion. Finally, have we traded below equilibrium of the range? Okay, so now this is going to be specifically for let's say we have a model like this, right? A lot of the times we won't go that deep into discount, especially for continuation models. And the reason for that is because we're going to be like very bullish, right? So a lot of the times it's not really necessary to go and hit equilibrium of the range. But let's say we have something like this, right? Where we have a really, really strong impulse leg, and then we have multiple for rally gaps here, right? We have 5 minute here, 5 minute here, 5 minute here. I will never really take, usually, very rarely will I take the first inversion off of this premium 5 minute. I actually will like really never do that because of how premium it is. Now, it will be okay if we have a run lower than that, and then we go here, and this won't, necessarily, we probably won't hit perfectly equilibrium, but it's still going to be more valid to take than this because of how premium it is, right? Premium discount is really just going to give you that best possible risk to reward, and this is enough for me to take a long from here, right? But obviously ideal A plus scenarios for price to go down and hit discount and then trade higher. But if we have a for rally gap that's like the second one here and then we don't hit discount, it's okay. So again, I'll show you guys more examples from that, but let's get into the next one here. Is there equal high? This one, okay? So this is going to be for whether or not we actually want to be taking the trade, okay? So have we already met the objective of the trading session, right? So have we already had like a fat 300-point move, and is price most likely going to chop? Yes, right? And you want to be paying attention to then if 11 o'clock can do the work, right? We're most likely after having a large expansion, from that 9:30 to 10:30, the last 30 minutes of that is usually going to look something like this, and then we will have that 10:50 macro run. So you don't want to be trading during this time when we're chopping and we are generating liquidity, okay? Is there equal highs, equal lows, or low resistance liquidity where your stop loss would be? Okay, so what that looks like is equal highs and equal lows, right? I do not care about equal highs or equal lows if they're on the 1 minute time frame and if they're right next to each other back to back, right? So back to back equal highs and lows, I do not care about. However, if they're spread apart like this, right, and let's say we had equal lows like over here, right, I do care about that. Let's say there's a low here and then there's a low here. I do care that if price wants to hit this, these equal lows, because then this is like a much stronger draw, okay? But just 1 minute time frame, I'm not really caring about. Also, you want to be paying attention to the overall delivery of price, okay? So if we have an inversion here, what you can see happen if we do something like this, right? Say we have like this, and then we invert it, right? This is not going to be the best inversion. Now, why is this? Because displacement is very, very important when it comes to inversion for rally gaps and the way I trade. Because this is not clear delivery. Why? Because now we have generated low resistance liquidity. What this looks like is just lows that haven't been taken by other lows. And that's not going to be good. A lot of the times when we take a while to invert a fair value gap, low resistance liquidity will form. And this is going to be a stop rate. And this is going to be a sign that price wants to continue to trade lower, right? And I'll show you this, and we can also, use this as to our advantage when we're trading continuation models, because a lot of the times what we will see is if price has failed to make a reversal, right? So let's say we have a move like this, and let's say price has failed to make a reversal, and instead we start generating liquidity, then this is a sign that price wants to continue higher, okay? So do not be longing when we have low resistance liquidity at your stop loss, and don't be shorting when you have low resistance liquidity at your stop loss and equal highs and equal lows, okay? Do we have clear lower time frame structure confirming bias? So not only do you want your external targets to align, you also want your internal liquidity pools to align as well. You want equal highs, you want low resistance liquidity, right? Models inside of models is what I always am saying. And what that means is the higher time frame model and higher time frame picture, if it looks like this, your lower time frame picture should look like this. Like if your 4 hours looking like this, your 15 minutes should look like this, then your 5 minutes, then your 1 minute should look like this. All of the time frames should be aligning to give you the highest probability setup, okay? And then finally, or not finally, I keep saying finally, but there's news coming up. I do not, very rarely will I trade before news, and I do not suggest trading before news because the majority of the time it's going to be choppier conditions before news, and then we will have a news candle, and that's a lot easier to trade because there's most likely going to be data highs and data lows, and you can take your trades based off of that, and it's going to be a lot easier, right? Now, times where I probably might trade before news will be like if we have 9:30, let's say there's like 8:30 news and then there's 10 a.m. news. Give me 1 second, sorry. All right, I'm back. Sorry, my dog just started barking a lot. But here is the news coming up, right? So I was talking about news, okay? So again, if we have 9:30, provide some sort of manipulation in the market, right? So if we have price doing this and 9:30 has a really nice Judas swing lower, and then we have a distribution, 10 a.m. is most likely going to deliver to that draw and we will not have that manipulation, right? So you always want to be seeing where the manipulation is in the market. This is the most important thing basically in all of my trading, and it applies to all my rules and applies to all my bias. Literally everything is manipulation in the market, and when is that happening and where is that happening, most importantly, okay? So true manipulation, right, is going to be when we sweep out those lows, sweep out that highs. This is not true manipulation. You're most likely then going to see 10 a.m. have the manipulation, right? So always be paying attention to where that manipulation is happening and when, okay? And that will decide whether or not I'll trade before news. Most of the time, I'm not trading before news though, okay? Now, am I in a good mental state to be trading? This is really, really important because a lot of the time, guys, I will be completely honest with you during the live sessions. If I am, either feeling emotional after a trade and feeling like I'm done for the day, and a lot of you guys won't understand that because you will feel these emotions, but you can't step away from the charts, which is the most important thing ever. For example, literally today, on this day, Monday, July 7th, whenever you guys are watching this video, I had a trade that was very, very good, and I literally missed my take profit by 2 ticks. It ran all the way for 2 point something R, missed my top take profit by literally 2 ticks, ran all the way back down, and stopped me at a break even. Now, I am a human, just like all of you. I'm human at the end of the day, right? I feel emotions, and that is okay. I hate people that are like, oh, you have to be emotionless when you're trading, blah, blah, blah. And if you're not emotionless and trading like a robot, then you're going to be unprofitable. And that's true to a certain extent, right? I am, a lot of the time very emotionless, but at the same time, I'm able to understand my emotions, which is even more important. And what I mean by this is, for example, let's say I have taken, this trade, right? And I'm ended up being break even on the day. Immediately, my thought process is going to be what? Well, I was up this much on the day, and that sucks. And now I want to be back at that point where I was up that much and claim that amount of profit, right? And immediately my brain starts going to these scenarios and how I'm able to make, back this money, or how I'm able to go back green on this day. And that is not the right way to be trading, right? You want to be in a mental state of trading where you are only focusing on the setup that is presented to you, not how much money you're going to make, right? And if you start getting into that mental space of, oh my God, well, I need to go back to green on the day. Maybe I took a loss and now, maybe I was up on the day and then I took another trade after that and now I'm red on the day. I want to be back to the point where I was green. No, already you're off to a bad start. So understanding what your mental state is, every time after you take a trade, every time even before you take a trade, ask yourself, am I in the right mental state to be trading? Have I accepted the risk is the most important thing. So I'm going into every trade and I'm asking myself, if this is a loss, will I be happy with it? Okay? And if the answer to that is no, then I'm not taking my trade. Okay? If the answer to that is no, then I'm not taking my trade. And with that, you guys need to also be focusing on how much you're actually risking, right? I did post a risk management video that I do want you guys to check out in the premium community. And that's going to be really, really important. You need to be understanding your risk management because there's so many times where, literally, I'm taking a trade, and the reason I'm able to be kind of in that emotionless state of trading is because I know, oh my God, if I take one loss, then I'm going to take, a 0.5% loss. And that is going to take 6 losses in a row for me to blow this account. Let's say I'm break even and I have a 3% drawdown, right? That is going to take 6 trades for me to blow the account. That is very, very unlikely. So I'm completely in a zen state of trading, right? So risk lower to the point where you are at that zen state in your trading and you don't feel any emotions. And then you could slowly start risking more and more and more until you get that mental strength And, if you start feeling emotional again, go back to whatever risk you were at before. Okay, but just always understand your emotions is the most important part of trading. And have I accepted the risk? And then have I taken more than 3 trades a day? I'll just put this more than like 2 trades a day, actually. For you guys, I think 2 trades a day on the day max, right? And then have a 1% max loss limit on the day, right? Be risking 0.5% every day, and then have a maximum of a 1% drawdown limit on your day. I think anything after that, number one, your overall mental capital is not going to be there, right? Your mental state's not going to be there. And 2, overall, your bias is wrong. Your draw on liquidity could be wrong. Or 3, just conditions are not high probability. And it's just most likely going to be choppy. And you might just not be trading with your edge also. Okay. Now let's get into some drawings really quick of the 2 different types of scenarios with my continuation model. Now, this is going to look like this, okay? So the first scenario with your continuation model is if we have already taken out the buy side, right? So actually I want to show first this scenario. Okay, sorry. Let me show this first. This is going to be like the most A+ scenario, right? We have not hit the buy side, right? Or, I'm just going to keep using bullish examples here, okay? And obviously flip this around and flip my wording around for a bearish example, right? So for this example, we haven't hit the buy side yet, right? We made, relative equal highs, but it's very, very obvious that price is trending towards here, right? I don't need to really elaborate on this too much, right? But it's very obvious that we are delivering from sell side, we are respecting bullish PERAs, and we're disrespecting bearish, right? And from here, I need to see a pullback into a 5-minute or 15-minute for value gap, right? This is absolutely necessary for my continuation model, okay? I'm not taking trades. Very rarely will I take a trade off of like a 3-minute, okay? I do not want you guys to be taking trades off like a 3-minute gap because a lot of times it will be a stop rate, and time frame alignment on that is really just not the best when you're using a 5-minute for value gap. It's best to be using like 1 minute to 5 minute as, your confirmation from that gap. Okay, and then an A+ scenario looks like is we could do something like this. NQ could look like this, where we have an SMT at this, or NQ could look like this, where we have an SMT at this 5-minute, and it might look like you're trading against an unfilled gap, but it's actually okay because of that SMT, and that's even more confirmation that price is going to run higher, right? And then, maybe we have an internal liquidity pool, maybe even generate some low resistance liquidity here. But the thing I want you guys to note is you won't be getting very, very deep retracements, right? So you won't be getting, deep sweeps of like sell side like this, and then we'll have that run higher. Most of the time for a continuation model, we're going to be pretty high into, a premium, and this setup is still going to give you just a really, really nice win rate. Not the highest risk to reward, like with the, MEC model still does give a really nice risk to reward a lot of the times. If you're break evening and then leaving your runner, you can get really nice risk to reward because it's a reversal. With continuations, you're going to get a little bit of a less risk to reward, higher win rate for this model. Okay. With that, I want you guys to note that there will be times where you can trade against an unfilled gap. Okay. And what I mean by this is we can have a 5-minute gap right here. All right, and let's say price trades into this. And after price trades into this, we will open up a 15-minute gap right here, right? And then the inversion's happening, right? And you might be looking at the chart and saying, well, this still looks valid. I mean, well, this still looks valid, right? We hit this 5-minute, but this is now against my rules, right? Because there's an unmitigated gap here. Now, it is okay to take a trade because price will not go down here and resweep this, especially if we're bullish and we have a continuation model. Very, very high probability that price will not do that, right? Because why? Price has already mitigated inside of this gap, and price has already mitigated this range and already traded to this, okay? So it's going to be valid to take a long from here, and this is now called a breakaway gap, okay? So this is a breakaway gap. Now, from here, we have an inversion presented, and then we have our delivery towards this buy side right here. Okay, so A+ scenario, and again, this is your A+ continuation model, and let's just show it again with the SMT. Okay, now I'll show you guys the other scenario that we have, which is going to be if we have already taken out this buy side, right? So let's say we have this run lower, and then we have a run higher, and then we have like just a super strong like impulse leg, and then we already take out the buy side, and there was no possible entry for it, right? Let's say we just had something like this. Okay, now you do not want to be longing, and I see a lot of people get mixed up here. And there was a very similar scenario where we had a trade idea like this play out, and people were asking me, Blake, is this a valid long to be taken, right? We have an SMT here. Let's say it looks like this actually, and this is kind of what I went over a couple minutes ago. And we had one gap here, but then we had a discounted gap like here. This is like the second 5 minute fair value gap, right? This is not valid because one, we are too premium. So there's two reasons this is not valid. One, we are too premium, and two, we haven't generated internal liquidity pools yet. So once we have taken the external liquidity, being this buy side, right, you want to wait for internal liquidity to confirm that price is still bullish, or still bearish, but for here, still bullish, okay? And the reason that you don't really need, that low resistance liquidity here is because there's still a valid liquidity pools, right? There's still liquidity resting. But after price has taken out liquidity, we most likely generate liquidity after that, right? And you usually see this continuation type of model happen at around 10:50 to 11 o'clock, right? So that 10:50 continuation happens a lot of the time. You will also see this happen, maybe we will have a big run up at 9:30 to 10, and then, maybe before news drops or something like that, and then we'll have a 10 a.m. open low. But a lot of the time it happens at that 10:50 macro, we will have that delivery happen. Okay, so you want to be paying attention to that low resistance liquidity and if it's generated, okay? And that can be in the form of like these stop losses resting here or in those equal highs and equal lows. And then you want to see that run happen, and then you want to see price trade slightly more discounted towards a unmitigated 5 minute or 15 minute gap that's lower into the range, and then you could take your long from there. So this is still A+ in my books because of how high probability this setup is. And it's a very, very nice setup. And you also should be looking to the left of you and seeing if there are more targets that would also make this like a higher probability setup. If there's like, let's say like an unfilled 15-minute gap here. Okay, boom, that's still like a good reason for price to go higher. At all-time highs trading though, this sometimes doesn't get presented to you. But I'm going to show you guys two examples, or I'll show you multiple examples, but multiple examples of what this continuation model looks like on the chart. So let's get into that. All right, I'm going to show you guys the first example when we don't take out the external buy side liquidity and what that looks like. Okay, so the ideal scenario for getting in these continuation longs and discretionary model in general is getting in at the bottom of the reversal that happens, right? And again, this is going to be for RR reasons, because then you can get like in a really insane RR like this. But sometimes if we don't have a mech model, it's not really like my favorite to be taking like these types of reversals, only if it's, again, I'm really, really confident in the reversal happening. But yeah, so let's say you don't get in on this, right? This is when the continuation model comes into play, right? What you want to be looking at is a 5 minute or 15 minute fair value gap. So in this leg, we only have one 5 minute gap to go off of, right? And this is great because we don't need to wait for like a discounted one or anything like that, and we don't have to worry about that being unmitigated. So from here, we still have data highs intact, and we tap into this 5 minute gap, right? It is not necessary for price to sweep liquidity here, right? Because why? We've already swept liquidity to the left of us all the way over here, right? So we've already swept out this liquidity pool here, okay? So it's not necessary for price to go down and sweep more liquidity. This is going to be a rebalance in price. And this low is going to be protected until the external target has been taken, right? This is in buy models, right? Buy models look like this. A market maker buy model has a distribution like this, where the lows inside of gaps will be protected until the high has been hit, and then it could be used as a target. Now, this varies between if we have, 10 a.m. opening, and sometimes we will have the resweeps happen, in lower probability conditions, or if you're taking setups off of like a 3 minute fair value gap, and then there's a 5 minute underneath, we're most likely going to that 5 minute gap, so don't be longing against an unfilled 5 minute, but yeah. That being said, From here, we look at this leg. So from this high to this low, the valid entry here is going to be this inversion right here. So this inversion will take you to your draw on liquidity. Once it's closed above, you can go long here, and then stop loss placement on this can either be, we have an order block right here, so you can put it at this order block, or for the most safest, stop loss to be at here, and then you can target that external liquidity pool, go break even at the internal high, and then that's your beautiful TP for 1 to 2 RR. Still really good RR on this trade. So yeah, there is that. All right, I'm going to show you now another example of what a valid model, continuation model looks like. Okay. All right, I'm going to show you guys another example, and this is not like the highest probability setup. I'll say this first off, because we don't have any external targets at all-time highs here, but I'll show you guys the importance of low resistance liquidity on the lower time frame for these continuation models and why it's so important, especially from this 1030 to 1050 to like 1110 macro. And it's always presenting itself. Like I'm always seeing this when we have like big runs in the morning. So we had a very big run. We took out all this buy side here to the left of us, and from here to continue being bullish, right? You would either want to see price. You want to see price do this, right? And then 10:50, 11 o'clock, we'll have that run higher, right? A reversal will just look something like this, where we have very clear displacement, right? And have very fast candles, okay? So as you can see here, and this is a trade that I did end up taking. We end up chopping around, and we end up generating lower time frame liquidity. Highs here, highs here, highs here, highs here, right? And what I'm looking at this current trading leg, right, we have an unfilled 15-minute gap right here. Beautiful, okay? And then this is also going to be an unfilled 5-minute gap right there. Okay, and what I'm talking about, also, I want you guys to be paying attention to this, is we have 2 5 minutes in this leg, right? I am not, remember when I was talking about like the premium and discount, there are 2 5 minutes in this leg, meaning that I'm not going to take this 5 minute. I'm waiting for the discounted one right here to get hit, right? And this is going to give you the highest probability entry, okay? So price ends up chopping around at around 10:30, and then once that 10:50 macro comes in, having this sweep of liquidity here, and then boom, we get a 30-second inverse from this high to this low. There's a leg here that you can take, and then there's also this inversion that you can take right here. So you wait for this to get inverted. You can also take the 30-second if you're really, really confident in this. Probably like a close like here, but I like this 1 minute since it was the one holding us down. Once this 1 minute gets closed above, you can enter longs here at the close, or if you want to have the best possible risk reward, you can wait for a pullback and then just target a simple 1R on this. Stop loss at this order block, 1 of 1.6R. And then this did end up hitting on, oh, there we go, finally hit. Full TP there, right? So that was a valid example, and I'll show you guys a little bit of a better example, but you can just see how continuation models are very obvious during that 10:30. Whenever I start seeing us chop like this and then start generating liquidity, and then we get this pull, like it's a very, very high probability setup, and this is one of my favorite types of trades to take. So I'm gonna find a couple more examples for you guys. Now, before I move on, I want you guys to also, I have emphasized this, but I want you guys to just realize the importance of high resistance liquidity versus low resistance liquidity, because it will really tell you just your whole entire bias if you just look at the market in this way. And this is how I'm always looking at the market, is where we are generating low resistance liquidity versus where we are generating high resistance liquidity. What does high resistance liquidity look like, right? We have lows here, and these lows are getting swept. And then we have the lows here, and they're just constantly getting swept, right? And sometimes they even look like this. We have like a 3 drive here, right? And when we have that type of pattern happen, those stop losses are getting ran, right? So liquidity is getting taken here, meaning that price does not have to go down and keep seeking this liquidity, because lows got taken here, liquidity got ran. lows got taken here, boom, liquidity ran. So we do not have to go down and keep taking out this liquidity versus low resistance liquidity looks like this, right? And we are generating, right, at the highs, and then low resistance liquidity, and then high resistance liquidity at the lows. Low resistance liquidity at the highs, high resistance liquidity at the lows. Give me 1 second. There's a fucking gardener right outside my window. All right, so back to the sauce, all right? High resistance liquidity at the lows, low resistance liquidity at the highs. That is what you want to see if you're bullish, okay? And if you're bearish, you want to see the opposite, right? High resistance liquidity happening where? At the highs, and low resistance liquidity happening at the lows, okay? And that's that, all right? Very, very simple way to just look at the market in general and give you your bias. So now I'm going to go back and find another example for you guys. Ooh! So this is a great example, okay? Really good example. I loved this because this was a trade idea I took also, okay? Continuation model. Why did I put 5 minutes? Buy side liquidity here. What's to the left of me? More buy side, right? So we do have more buy side to the left of us. But we did just sweep out a major prominent liquidity pool right here, right? And internal liquidity, okay? So let's say, because you're retarded or something, you didn't get in on this long here, right? And instead, we are getting a continuation model, which is completely fine, okay? Now, we did something like this, where we had a run up, and 10 a.m. ends up taking this out. So a lot of things to cover with this. So first off, what do we see? We see 2 gaps in this leg, meaning what? I want to take the more discounted one, right? Being right here. What do I also see, guys, that we went over? Devil's mark, okay? So there's a devil's mark here. If you haven't watched that video yet, I guess I'll just explain that. Or I don't know exactly what video I explained devil's mark in, but I'll explain it really quick. It's when we have price doing something like this, right? So we have a candle here, we have a high, and we don't print a wick at the low, or vice versa. If we have a bearish candle and we have a low, but we don't print a wick at the high, right? For this example, we have a candle here with an open high, and there's no low, meaning what? That price likes to do things like this, trade back, and then hit that low to make a wick, and then continue to be bullish here. Okay, so when I'm looking at this idea here, and I see that 10 a.m. is taking this, I'm going to be paying attention to that 1050 macro, right? Not only that, I'm going to be paying attention to this discounted 5 minute, right? And I'm waiting to see if this wants to get hit, and I'm also going to see if we are generating liquidity. Are we generating liquidity? Looks like this, versus and it's a very slow and choppy process, or are we going to have a very strong displacement lower and Drake candles down? That is not what I want to see if I'm taking a continuation model, okay? So as you can see here, price ends up going like this, chopping around, and we actually had an idea here that a lot of people took. And I told people, I'm not taking this long. The reason I didn't take this, people were like, oh, but we're bouncing off a 5 minute, and then we have a 1 minute inversion. And there was also an SMT at this low. But why am I not taking this? Number one, guys, too premium, right? We are way too premium in this price leg. And then number two is we didn't hit that discounted 5 minute. And number three, we didn't even hit this devil's mark, okay? Okay, so this gardener just loves to garden right outside my window. To garden. Anyways. And those are all the reasons, right? So instead, you wait for price to generate liquidity. Also, we don't have any generated liquidity. You are targeting a high that has been taken by another high. You're targeting just the most high resistant high there is. Instead, you want to wait for price to generate liquidity and generate some sort of break-even spots also. Break-even is very, very important in my trading. So that's what you should be paying attention to. Okay? I had to get that gardener. I had to tell him to leave. Anyways. So what price ends up doing is we generate liquidity. We trade lower. We hit that devil's mark there. Beautiful. And we get that bounce from there. And this is also, would you look at this? Sorry. A discounted 15-minute gap as well. Beautiful. Hit that. And then from here, you take the highest time frame inversion from, that trading leg that ended up sweeping out that liquidity. And here it's actually just a 1 minute gap. Beautiful. Beautiful risk to reward. Beautiful RR. Long here. Stop loss at the wick because you can, because of how good this RR is. And then you close once that SMT gets made right there. And that's the trade. And beautiful. It's TP. Okay. So absolutely textbook setup there. And yeah, there was an SMT here, guys. This is why I closed early, but yeah. Show another example in 1 second. Now for this final example here, guys, I want to show you the importance of breakaway gaps, okay? And again, I just explained what a breakaway gap is, but as we can see here, we have a 5-minute bullish for rally gap that ends up getting created, and this is your continuation model here, right? We did sweep out liquidity. So for me to be bullish, I want to see price generate some sort of liquidity, trade lower, and then have a nice reaction out of this 5-minute gap. Now, we end up doing this on this day. This is a pre-market trade. We generate some nice liquidity here. Not the cleanest low resistance liquidity run, but we get a really, really nice bullish reaction out of this. And then from this high to this low, we look at the trading leg right here, and the highest time frame inversion is this 4-minute. Okay, so the 4-minute's highest time frame, and then you can long this 4-minute gap right here. Right, so looking at this idea, all right, looking at this, we look at the 15-minute time frame, and we see that price has made a new 15-minute gap, right? And this is opened at 9 a.m. And would you look at this, price is now closing at around 9 a.m. So you might think to yourself, I'm not going to take this long because now we have an unmitigated, because we have an unmitigated gap right here. Now, the reason that this doesn't matter, guys, is because we have already traded into this 5-minute gap. We have already rebalanced this whole entire range, right? If we draw out premium to discount also, this range has already been rebalanced, okay? So there's no reason for price to go back and trap into this unmitigated fair value gap, because this is going to be a breakaway gap. And this is a really nice example of, not like a perfect example of a, continuation model, because there's not a lot of low resistance liquidity here, but it's a really nice example of how a breakaway gap is being used in this scenario, okay? And then this does end up running for full TP and an absolute banger setup on this day. All right, so that's pretty much going to wrap it up, guys, for this lesson. Hopefully, you guys learned something about these continuation models and just overall trading more discretionary, and understanding conditions and understanding where high resistance liquidity is and where low resistance liquidity is. But yeah, that being said, guys, screenshot this if you haven't already. And your homework for this lesson is going to be to go over, 3 examples of some valid continuation models. Okay, and also I want to put in this just some valid continuation models, or just overall trading more discretionary, targeting things that are not just going to be your unfilled and unmitigated gaps. Okay, but yeah, screenshot this, and I'll see you guys in the next lesson. Peace out.